Hey, JKJ Digital Assets Premium members, we're back again and we're going to give you a little more tax information that we've come up with. We've put together a few more scenarios. Hopefully you've had a chance to go back and look at the original tax video that we put together for you. John did a great job with some of the PowerPoints in there. And, we covered a couple different scenarios and we covered some things about tax forms. We looked at how you figure when you buy. We looked at what you do when you buy and sell. When you buy it, you move it someplace, you sell it. All those interesting things. Not really. But all those things about figuring up cost basis and all that kind of exciting stuff. Now today, what we've got in this video is we've kind of got what I would consider the final general scenario that you're going to get into unless you're getting way deep. Today, we're going to look at what happens when you buy something, you move it, and then you buy something else with it. So John's going to jump in there. But again, just for everybody's knowledge, we want to always make sure that we put this out there when we're talking about taxes. We are not tax professionals. We are not tax advisors. We are just arming you with some information that you're going to need and you're going to want when you go sit down with your tax advisor and the tax professional that's helping you to do this. Again, these principles apply to any type of commodity that you're going to be moving around with. But what we're doing today is we're just going to show you some more examples. And John, you want to jump in there and let's start this PowerPoint up and go over a few more scenarios?
Yeah, definitely. This is 2 of 3 in a series about taxes. So if you have not watched the first podcast on taxes, go ahead and watch that thing and get prepared because we're building on a concept from the first one. So definitely the financial advisory disclaimer. We are not doing tax professional stuff. We're giving you just information to help you move around this crypto world. So this one, we were going through case studies. Oh yeah, we'll do a quick review. So yeah, almost everything you do with crypto will create a tax event. And I say almost, we'll talk about some things that are not tax events. But almost everything is a tax event, and tax events, whether we like it or not, are reportable to the IRS. If you make moves in the investment world and you don't report to the IRS, you expose yourself to liability in that way. So go ahead and move on to the next one. All right, so again, these are all the pertinent documents and everything that you'll need to have this conversation with your tax professional. We'll have them on the website. I recommend you go and read them all. Many of them don't have to do specifically with crypto. The IRS publication 544 on down, those are all normal tax documents that your tax professional should be familiar with, but you should be familiar with them too to help educate yourself as you make crypto transactions. So I pulled out some particulars that are important. All of your transactions, all your information, whether or not you're working with crypto or not, it's reportable in US dollars. So you're going to have to convert it from US dollars to crypto. And anything that you use, CoinMarketCap or CoinGecko or any of those things, they're suitable to make that fair market value determination. All right, so when you're dealing with cryptocurrency, again, this is a review from the last podcast. There's 2 ways that you're going to be taxed. One of them is on regular income, and that's if somebody pays you for work in Bitcoin, airdrops and rewards may be looked at as income. The other one is capital gains or losses. So it's capital asset, a gain or loss on a capital asset. So it's either income or it's a capital asset.
Okay.
All right, one more click. All right, so we went through 2 case studies before. We're going to move on to the 3rd case study. This one's a little bit more complex. So the basics behind this is you're going to buy, in this case, Ethereum, move it to another exchange, and then make a purchase using Ethereum. And the reason this is pertinent is because if you are moving outside of an exchange that you can make a purchase with US dollars, there's many cryptos that you're going to buy with another crypto, probably Ethereum, maybe Bitcoin or whatever. So this maneuver that we're talking about is not out of the norm. You may buy Ethereum, send it to, in this case, we're going to send it to KuCoin, purchase another crypto with that Ethereum. But there is some tax hops that happen here. So you're going to create a tax event when you don't really realize that you're doing it. So Again, we made this pair up to the first two case studies just for reference purposes. So again, if you haven't watched the first podcast on taxes, go back and watch that. You'll recognize these numbers right away. So this first one on January 1st, Ethereum is worth $3,000. And we're going to be using crypto.com, and we're going to purchase one Ethereum and incur $40 in fees. So just like before, your cost basis is $3,040 because your fees are factored into the cost basis, and the fair market value at that moment is $3,000 for your Ethereum. All right, so later in that day, you're going to take your Ethereum and send it to KuCoin with a fee of $25 for that transfer. Your tax basis information for the original purchase on Ethereum is back in crypto.com, just like before. KuCoin has no idea how much you bought that Ethereum for. They just know they received Ethereum into their exchange. All right, so still January 1st here, magically and wonderfully, Ethereum is now worth $3,500 over that time frame, and it does move.
It's been a good day.
Yeah, it's been a really good day. Ethereum can move like that. So just for setting the scene here, Ethereum is now $3,500 and Luna is $100. Luna is the thing that we're going to buy in this, and it costs $100 each. So we're going to purchase 34 Luna and incur $100 in fees. So I did this to make it really clean. We have $3,500 worth of Ethereum sitting there. So we have no more money left, no more Ethereum left in KuCoin. We have 34 Luna sitting in there. So just to lay it all out there, Ethereum, the fair market value is $3,400, $100 in fees. Our proceeds from, we sold Ethereum and bought Luna. So there's a hidden tax event in right there. We just, the Ethereum over our time frame went from $3,000 to $3,500. So there's a gain that has occurred there, and we sold it for Luna. So we have to account for that gain. So our fair market value in that moment was $3,400 and our $100 in fees. So our proceeds were $3,300 from that. All right, so again, just to lay this stuff all out, our original cost basis for our purchase was $3,040. $25 in fees don't really matter other than they're lost. We went from Ethereum to Luna and with $100 in fees. So we have our proceeds, and what's reportable from that transaction is $360. And that makes sense. We had $40 to purchase it and then $100 in fees to buy the Luna. So it's $360. It's reportable to the IRS for that. But now the thing that is important down on the lower half of that, I've marked it as Luna. Now you have a new asset that is Luna, and there's a new cost basis for that asset that's sitting in KuCoin now. This is the complexity that we can run into with crypto transactions. Now the cost basis for that asset, which is Luna, is sitting in KuCoin, and its cost basis right there is $3,400. The reason it's $3,400 is you don't get to count those fees twice. Like in my scenario here, I put the fees to buy the Luna in with my Ethereum sale.
Okay, so that comes off the original cost basis.
Yeah,
okay.
Exactly.
Right.
And you could, if you wanted to pitch it to your tax attorney to move over to the cost basis on Luna, you could do that. But the point is, you don't get to do it twice. It's just once. So
okay.
All right. So that kind of completes that case study. It's I wanted to demonstrate how you can have unforeseen tax events occur. And so, like, you know, if you are a day trader for equities, like the U.S. stock market, if you're a day trader, it's super easy because, you know, at the end of the day, you wake up at 9 o'clock in the morning and you start day trading and you do all these trades and you're making money like mad. At the end of the day, you sell everything off. You have U.S. dollars in there. You may have incurred all kinds of gains that are reportable to the IRS, but it's easy to pay your gains because you have a bunch of U.S. dollars sitting in a bank account at 5 o'clock that afternoon. So it's no problem. I wanted to demonstrate with this case study that you could have gains, but now you don't have any U.S. dollars sitting there to pay them. You have Luna, which is an asset that has value, but you can't pay your tax bill with Luna.
Right.
So it just have to be aware that there could be a tax event that occurs
Where
you don't now have US dollars sitting there.
No, that's a great point, because that's something most people would not be on the top of your mind. You would be sitting there thinking, well, hey, I made this money, or I did whatever. Yeah, but you can't write them a check and say, all right, here's your 1.5 Luna to pay my tax bill. Yeah. Not yet, anyway.
Well, eventually, when your tax bill comes, you create another tax event just to pay for your tax bill.
And now I have to sell what I just did.
So this is why I use the analogy. I don't know if you listen to the first podcast. I use the analogy of, I hand you a brick of gold, and then you take that gold and you buy silver with it. Like, there's been a tax event there that occurred between your gold exchange and your silver exchange, and but again, you don't have any US dollars sitting there. So it's all based on in this arena, it's all based on the fact that this is an asset, or the IRS determines it's a capital asset. It's a thing that's sitting there that you're buying. I know it's a digital currency, but they look at it as like it's a thing sitting there.
So you really, you kind of have to sit there as you're making your transactions and figure out, or keep track of how much you're trading. I mean, how much you're making, or you're losing. Okay, so you keep track of it, and at the end of the year, like I said, you create another tax event by paying the bill with selling more crypto, but at least keep an idea of what you're doing in a book or in a notebook or someplace else, wherever you want to use. You want to keep track of it. So.
Well, let's move on, and we'll talk about the next section of this. Go ahead and click next. All right, so case study 4, I wanted to talk about airdrops and rewards. And you may or may not have run into this in your crypto journey, but they're out there. It's a thing, and as with everything, there's a
I like airdrops.
Yeah. There's a tax event that occurs with these too. So, JD, can you tell what an airdrop is?
Well, let's say you're staking. For instance, let's talk about Luna, or you just put Luna on there, right? So let's say you take your Luna. Staking is just a way of you taking your tokens and giving them back to the same company. And they're going to use that for liquidity. So depending on what they're doing, whether they're growing the company or they're lending money out, they need the liquidity. So what you've done is, hey, I've given you part of my money, and they're going to take that, and as a reward, what they'll do is they'll give you staking reward. So basically it could be in the form of the same Luna, which is what's happening right now on Terra Station. And let's say another company uses Luna or Terra Station, which let's call Terra Station, for instance, an Apple iOS, right? So you already know what happens when an app is thrown onto your Apple iOS, right? That company's paying probably 10% to Apple for having that app on your cell phone or using the Apple iOS. The beauty here, however, is that the company that's landed on top of Terra Station, because you staked, is going to provide you with tokens that are coming from that company. Let's say Anchor Protocol. Anchor Protocol decides to use Terra Station, and because you're a Luna staker, the money that would have gone all to Terra Station now gets partialed out, and so you get a little portion of that, and and it would show up as an airdrop. You all of a sudden show up with this, you see this Anchor token, and you're trying to figure out, okay, what happened here, and it's because you staked Luna, and this is a big thing with cryptocurrency.
Yeah, it happens. There's a bunch of different occasions that can cause an airdrop to happen. The basics of it is that somebody just dropped free money or free crypto, and in this case, into your lap.
Yeah, it is free money.
Yeah.
So it's like a pseudo dividend or interest back on
the dividend. The dividend would be staking Luna and getting paid back in Luna, right? Okay. That would be and this one is just. This is icing on top of the cake. It's another company comes up, and again, instead of them paying Terra Station everything because they're using their iOS or their software, because you're a part owner of the company, by staking, you're getting an airdrop, you're getting their tokens. So that's kind of nice.
That's one company that does do the airdrop thing, or not company, but network, Terra Network. Yeah. You get a lot of airdrops in that. There's other circumstances that'll cause it to happen. It's all, there's all kinds of reasons that it would occur, but the point is that somebody, like the name implies, airdrop, somebody just dropped some money on your lap, and it looks like income, like regular income to the IRS. The other thing is a reward. Rewards are, my example of it is crypto.com. You go and you stake with crypto.com, and we all have this little credit card, a crypto.com credit card, and every time you use it, it gives you a little kickback. I think it's a 3% kickback on that card, but they give you that kickback. It's not in cash. It's in a cryptocurrency called CRO that they give that back to you. That card, if you have, what's the music service?
Oh, Spotify.
Spotify. Yeah. If you have Spotify,
those guys,
and you put it on the card, they will refund you your Spotify fees in CRO. These are all rewards. It's like an interest on a bank account, kind of. They will give you these rewards back. So airdrops and rewards, the IRS has made a determination about these things. So go ahead and click on the next page. So these airdrops and rewards, to account for them in taxes, like the moment that you gain control of it. So some rewards are held in abeyance for a certain period of time. Some airdrops and rewards you might get immediately. Like they drop it in your lap, you can take it and sell it or buy something else with it. So whatever the case is, like you're not responsible for the tax burden on that until you have control of whatever they dropped on you, rewards or airdrops. So if it's held in abeyance at some point, you're not required to report that as income. But assuming that you have control of it, you are responsible for it. There's two things that happen. Like when they drop this thing in your lap, the fair market value of that in that moment is what you're responsible for. And you have to determine that, and effectively becomes your cost basis for that asset. So, I'm just going to put some quick numbers to this. If you were to get an airdrop that's worth $5, you would be bound to report that $5 to the IRS. So you say you don't sell it and you hold that for 2 years, and now it's worth $10. So you don't owe the tax on the whole $10 because you already paid taxes on the first $5 of it. But you owe taxes on the difference, which would be another $5 on that when you sell it. But that only happens when you sell it. So
I'm starting to get dizzy.
I know, yeah. The first time it was taxed at regular income, just like if you were working at 7-Eleven, someone paid you $5 an hour, you get taxed on that like it's a regular income. The second one, it's an asset, and you get taxed on the gains of it. So I know it's a mess, but this is what the IRS has determined. And I have a lot of rewards that have occurred. Like we've had that card for 1.5 years now, and you get 3% back on it. We drank a lot of beer on that card.
Kevin did. Kevin even used Ethereum to buy his.
I did.
Kevin and his $80 glass of beer. All right.
Hey, it was good.
It was good.
It was hot that day.
All right. So back to the PowerPoint here. Sorry. So yeah, it's taxed in 2 phases. First, when you get it as income. Second, as a gain or loss from sale of an asset. All right, go ahead and click next. All right, so wrapping up on this again, I'm going to keep saying this over and over again. Tax reporting details are your responsibility. You have to keep track of them. Even if you get 800 rewards from crypto.com over the year, you're still responsible for reporting it. The good thing about it is that you can take those 85 rewards and you can lump them all together on that form as one transaction, and average out the cost of it and get the total thing as your income. So it doesn't have to be, if you get 400 rewards, you don't have to do 400 line items on there. You can compile them, and you wouldn't really even do it. Your tax professional would do it for you. So and then again, we have to keep track of your cost bases. Even if it's airdrops or rewards, or if it's just purchases, the cost basis is everything with taxes. You have to keep track of those things. And then these digital assets can be income, regular income, or they can be a capital asset. Or in the case of rewards and airdrops, they get taxed as both along the way. So.
And that's why it's important to have a tax professional to guide you through all of this, because certainly we are not tax professionals. We are just presenting some information, and obviously this can get complex. So that's why you need to go to a professional, somebody that you can trust, and you let them walk you through this.
Yeah, and if you're new to this, the other thing you're probably going through your mind at this point is, where do I find all this information? Crypto.com is really good. I mean, you can go through it and find every single transaction you've made. Coinbase, the same way. MetaMask, if you use a MetaMask, it's a little different. Yes, you can find your transactions there. The difference, however, with them is if you're making transactions on your PC and also on your cell phone, those records are going to be in two different places. So you're going to have to go chasing those depending on where you made the transaction. And you'll learn how to do this. And we're here to help you out.
Absolutely. So as we keep going through tax season, we've got this is part 2. We've got one more podcast that we're going to put out here, another quick little video to hopefully help you just kind of put a bow on this thing of just some of the things that we think are important that you take to your tax professional and whoever your tax advisor is. Again, we can't say it enough. We are not tax professionals. We're not here telling you how to do your taxes. We're just providing information on some things that you're going to run into when Uncle Sam comes knocking and goes, hey, time to pay up. Just letting you know what you're going to need to have available and some different things that'll be there that your tax advisor should be asking for. So again, just a chance, give you knowledge like everything we do at JKJ Digital Assets. We're here to teach. We're here to provide education. We're not here to provide advice. So again, since you're a premium member, you know all this. We thank you so much for joining up with us. We thank you for being a part of our special group that we've got as our premium members. Tell your friends, tell your family, let everybody know. This information's here as we go through our crypto journey. We're looking forward to continuing down this road with you. And again, come back and view part 3 of our tax series here soon. We're looking forward to being a part of this with you. Thanks, and have a great day.